Hello everyone and welcome back to the channel, and I hope you guys are doing great. In my today's video, I'm going to discuss with you about Utkarsh Small Finance Bank. We are going to go through the recent Q1 FY27 result and the main points from the concall summary and see how things are progressing. Because if you would have seen my video earlier on this bank, right? So the reason I'm tracking this and the reason I'm very interested in it is like because the business after the IPO it came, it went southwards, things went bad, the asset quality deteriorated. And now what I've seen in the past 1 year that the business is turning around, things are improving, things are getting better, losses are slowly coming down. So we will go through this result and see how this turnaround is going on, whether the turnaround is complete or it's on its way, how the numbers look, and what does the number say about it. So let's get into it. So if you look at the screen over here, right? So here are the main points. I have highlighted them in the red boxes. I'll just go through it. So if you look in terms of their overall disbursements, right? So total disbursements, if you look at it, it grew by almost 48.5%. And if we divide it between micro banking and non micro banking, so the micro banking disbursements grew by almost 29%, 0.3%, and non micro banking disbursements grew by almost 71.7%. And to be very honest with you, I am quite happy with these numbers. The reason I'll tell you why, because the management has told in their past calls that they want to increase their non-micro banking portfolio, which is a more secured part of the business, to close to around 55 to 60%. So obviously, for them to increase that compared to the the unsecured portfolio, which is related to micro banking, they have to lend more and more to the secured part and less to the unsecured part. And over here, we can clearly see that the micro bank disbursement has grown at 29%, but the non-micro banking disbursement have grown by almost double at 71.7%. And if we go down further into this portfolio and see how the disbursements have happened, right, we can clearly see that micro banking portfolio loan has degrowth by almost 20%. A non-micro banking portfolio has increased by almost 21%. Secured portfolio has increased by almost 17%, and unsecured has gone by 10.4%. So this shows that what the management has promised or what the management wants to achieve, they're already working towards this. And if you look on the right hand side over the secured and unsecured mix, right? At the end of Q1 of FY26, secured book was only around 45% of the portfolio and 55% was unsecured. But if you look in Q1 of FY27, the numbers are, the numbers have changed. Secured has increased from 45 to 51%. Unsecured has reduced from 55 to 49%. The only disappointing thing, what I found it over here, right, in terms of CASA deposit. So CASA is nothing but current and saving account deposit, and the more the bank has more of these deposit, the cost of the cost of fund is quite less. Over here, if we look from the YOY, it's quite good at it grew by almost 15.1%. But in terms of if I look quarter and quarter, that was disappointing. It degrew by almost 6.3%. And the other thing, what has happened is, right, institutional term deposits, which were has decreased by 32.1%. So that means the institutions have reduced their deposits over there. So let's see how this progresses further. And if you look at their PAT, right, so they're still not profitable. But the one good thing is, like, last year they made a loss. Last year they were in a loss, but now the losses has reduced and come down to almost 34 crores. And if you look at from quarter and Q4 FY26 perspective, also Q4 they made a loss of around 188 crores, and now the loss is reduced to 34 crores. So in short, if I see from these, the performance snapshot that they have given, right, the management had promised that they want to move to more to the secured part compared to the unsecured part. And we can see that in not just in disbursement, but overall portfolio mix change also, which is happening. So that is quite good. The only disappointment part is in terms of the CASA deposits, which hopefully we should have grown at a in terms of quarter and quarter also. So let's get into it further and see the portfolio mix, right? So in the portfolio mix, if you look at the screen, it is divided into two parts, right? So first is the microfinance portfolio, where it has been distributed between GLG and non-GLG. So GLG is nothing, is joint lending groups. Over here, when the bank gives a loan, right, it gives to a whole group together, and they are responsible for it to pay together. And the non-JLG is the individual microfinance loan, which they give it to the individual. So if you look over here, right, in the March of 2020, the JLG was almost 90% and individual was around 10%. But now, if you look at June of 2026, it has completely changed. Now, 72% of the loans are been given to non-JLG, that means individual microfinance loan, and only 28% is being given. And if you would have seen other companies also, like they also what I see the trend is like most of them are trying to move away from the GLG, like try to reduce the GLG borrowing and go into the non-GLG to individual borrowing. So because over here, what happens, right? Then the way the loans are given, the individual is much more responsible and their credit history is much better, and they look at everything and then only give the loan compared to the GLG, where they look at the overall scenario, and sometimes because of one person, the overall group might look much better. So that's why things are changing over there. And if you look at the overall portfolio, right, in March of um, uh, in sorry, in March of 2026, right, as I said earlier, they wanted to improve their overall secured portfolio and reduce the unsecured part, and we can clearly say it is progressing. Now, secured portfolio is almost close to 51%, and unsecured is around 49%. And the management has given a target that they want to have a secured portfolio of around 55% in FY 28. So these were the numbers. So let's get into more into details and look at the profit and loss and see how the incomes have increased or how things are progressing. So if we, the only disappointing part of the overall result is, right, so their income did not grow at all. So if you look at the interest earned, which they compared to the last year, it was almost zero, just because the interest expense has reduced. The overall net interest income shows it around 5%. So that was the only disappointing part. But otherwise, in terms of disbursements, in terms of asset quality improving, things are getting better. And the most important thing is, right, I want to look for you guys to look at the bottom of the screen is, right, is the losses. Last quarter of FY20, Q1 of Q1 of FY26, they made a loss of around close to 239 crores, and this year it has come down to 34 crores. So they are still not completely profitable, but we can clearly see at the light at the end of the tunnel. From 239, it has come down to 34, and hopefully in the coming quarters or by the end of this year, they become profitable. And for a bank to become profitable, the asset quality has to improve. So let's look at the asset quality side and how things are improving for the bank overall, right? So if you look at the screen over here, right? So the credit cost has decreased from 8.5% in Q1 of FY26 to 2.3%. Then if you look at the gross NPA rate, last year it was around 11.4%. Now it has come down to around 5.9%. NNPA was almost close to around 5%. Now it has come down to 2.8%. This clearly shows that the overall, the loans which are getting bad is reducing and asset quality is improving from the bank. And if you look in terms of the numbers of these, GNPA and NNPA, right, we can see even bigger picture. Last year, they had a closing GNPA in Q1 of FY26 around 2,196 crore. Now it has almost come down to 1,163 crores. And if you look at the NPA provisions, right? Last year it was around 1,299 crores, and it has come down to almost 635 crores. So we can clearly see, right, that for the bank, whatever measures that they have taken in order to reduce their overall loss, improve their asset quality, has been working quite well for them. And things are not just being told, things that can be proven through numbers also. And if you look at the profitability matrix, right, so we need to look at that also, because if asset quality is improving, if things are going in the right direction, then obviously the profitability should also improve. So let's look at their various profitability metrics and the numbers and see how things are improving from them. So if you look at the screen over here, right, the operating the operating pre-provision profit was around 92 crores. Now it is around 64 crores. But if you look in terms of the provisions that losses that they had was around 239, which has come down to 34 crores. And if you look at the annual operating profit in PAT in FY25, they had around 24. Now it has, last year they had an overall loss of around 1,000. 151 crores. And if you look at their yield and cost of funds and net interest margin, that shows quite decent sign. I would not say it has improved drastically, but it is going in the right direction. So if you look, their yield is almost improved slightly. Their cost of fund has gone down from 8.1 to 7.7%, and net interest margin has slightly improved from 5.9 to 6.1%. The other important thing is, right, the return on asset as well as the return on equity is also improving, because last year the return on asset was negative 3.4%. Now it has improved to 0 - 0.5%. Return on equity was almost minus 33.8%. Now it has improved to almost 5%. So even though they are not profitable at this point of time, but the overall numbers are showing the signs, and they're like the car, which is Utkarsh Small Finance Bank, is going in the right direction. And if they continue this way and go ahead, right, then definitely there are chances that they'll become profitable. And if in terms of the con call and what the management said and how what was the feel about it, right? So first of all, the things that what I can understand, right, management is very confident that things are getting better. Losses have reduced drastically, and they have covered their microfinance book, almost 80% of their microfinance book under this CGMFU scheme. Management is quite confident of achieving around two digits ROE by the end of FY27, and they want to achieve a return on equity of almost 15% by FY28. So currently they are in negative 5% in Q1 of FY27. They are saying that it's going to reach to close to 10% by the end of FY27, and by in FY28 they want to achieve 15%. And if they are able to achieve it, there is no way no one can stop them from being profitable. And they have given this guidance, which is for FY28. Once things starts improving, so they're saying that the portfolio will grow at around 25 to 30% YOY. Return on equity will be 15%. Net interest margin will improve to 8%, and the secured loan book would be around 55%. So these are actually quite big target, because currently they're still not profitable. But the way things are going for the bank, right? And if it continues in that way and nothing changes, definitely they will become profitable. And at the same time, we need to look at this FY28 target and see whether they're going in the right direction. For me, the most important thing is bank turning profitable and the overall loan book as well as the overall income being increasing. And if you guys like this video and the analysis, please do hit like and subscribe to my channel. Thank you and